Yeah, I mean, I think if you go back and you look historically, what was the biggest company that got hurt last year when you had the issues with China? It was Apple. In fact, they came out and negatively pre-announced their results because they have high teens percentage of revenue exposure from China. But what I think people are forgetting is the tariffs that were put on last year, those were on industrial goods, those were on things manufactured there. Those excluded iPhones. If I've understood this correctly, this round of tariffs, the final $300 billion, that goes on consumer goods. So that includes things like the iPhone, et cetera. So this, in terms of where the tariffs are focused, this last round is actually much more damaging for the consumer companies, the guys that sell PCs, that sell iPhones, et cetera, which is what Apple does. So quite honestly, I'm actually surprised Apple's not down more because, they're at the epicenter of this much more than they were last year.
I mean, it's been doing really well since its earnings, which it sounds like from your notes you sent, you're not so impressed with, Dan.
Well, I mean, it's great that Apple beat the quarter, and that's true. But if you look at the composition of that beat, they missed the iPhone revenues, which people are obviously, that's the half of their revenues is in iPhones. And then everybody is being very bullish on services, but they missed the services revenues expectations as well. And so it's a testament to the company that, wearables made up the difference and did really, really well. But if you look at it, you go, revenues are up only 1% year over year, and the EPS is down 5%. And if you look at the stock, it's obviously had a great run this year and was up about 35% coming into today. So the biggest positive for them, in my mind, is they have $100 billion in cash on the balance sheet, buying back a lot of shares. They keep increasing the dividend, and that's terrific. But if you look at it fundamentally, other than those other factors, and it's a big portion of the index, and the index keeps going up, so more people keep buying it, it's not a company that I would want to own going into the fourth quarter, much like last year. But if you remember, last year the stock ran all the way up into October, even though we had all this China stuff going on. Why? Because it kept going up, so people bought more. And then finally it absolutely imploded when people figured out the fundamentals or were forced to focus on.
Dan, what about Alphabet or Facebook, which have also seen intraday turnarounds? Does that make sense to you under the guise of these tariffs moving them?
Well, I was glad to see them go down because actually we've been buying. So for us, no, that obviously doesn't make sense because if you look at Google and Facebook, one of the big issues is they're effectively locked out of China. And so one of the things going on with the trade war we have is trying to open up the Chinese markets to U.S. companies. So for me, I looked at this and I was really happy because I didn't own as much of those two names as I wanted to. They don't have exposure there. And if you look at Google, unlike with Apple, where revenues are up 1%, Google's business last quarter accelerated. Their revenues are up 21% year over year. If you look at Facebook, their revenues also re-accelerated. Their revenues are up 28% year over year. And with Google in particular, much like Apple has done a great job of being shareholder-friendly, Google for the first time, at least for me, they were much more shareholder-friendly in that they put out a $25 billion stock repurchase. They gave you some disclosure on Google Cloud that it reached over $2 billion per quarter. So I was really very happy with Google in particular and the way they sort of changed dealing with Wall Street.